Hello everyone. Let me ask you something. Does your financial reporting feel like outdated, chaotic? Okay, let's be honest. Well, it's time for an upgrade. IFRS 1 is here to save the day. Today I'm going to show you how this magical standard helps businesses move from local GAAP to IFRS smoothly and efficiently. And I promise no accounting jargon without a fun twist. Genesis of IFRS 1. Let's start with the basics. IFRS 1 was introduced in 2001 by the IASB. You can question why. And the answer would be because the world needed a unified way to report financial information. Think of it like switching from regional train tickets to an international pass. More complex, but you get access to a whole world. IFRS 1 is your guide for the journey. To talk about the purpose of IFRS 1. So, what's the point of IFRS 1? I would answer it simple. It helps the companies transition from GAAP, generally accepted accounting principles, to IFRS, International Financial Reporting Standards, without unnecessary stress. Ensure your financial statements are transparent and comparable. Make sure the cost of compliance doesn't outweigh the benefits. In short, IFRS 1 is like the GPS for your financial reporting. It shows you the best route for compliance without the detours. Okay, let's talk about what is IFRS 1 then. Now, what exactly is IFRS 1? It's the rule book for the companies adopting the IFRS for the first time. If you have been using the local GAAP or generally accepted accounting principle, IFRS 1 tells you how to switch and make sure everything is compliant. Think of it like a manual for assembling the IKEA furniture. Without it, you will be lost and probably have leftover the parts. It talks about the purpose of IFRS 1, focus on efficiency, applicability, cost benefit balance, and transparent reporting. What is IFRS 1? The furthermore description is provided using the steps. Step 1, identify previous framework. It says determine the current accounting framework used by the entity before transitioning to IFRS. Step 2, access IFRS requirements. Review the specific IFRS standard applicable to the entity's operation and reporting. Step 3, prepare the financial statements. You have to prepare the financial statements according to IFRS requirements, ensuring all disclosures are compliant. Step 4, implement changes. Make necessary changes in accounting policies and procedure to align with IFRS. Step 5, audit and review. Conduct an audit of the IFRS financial statements to ensure accuracy and compliance. Final step, step 6, publish IFRS financial statements. Publish the financial statements prepared under IFRS for stakeholders and regulatory bodies. To talk about the date of transition to IFRS, the most important, the date of transition. This is the starting point for applying IFRS. For example, if you are reporting the reporting year ends on March 31st, 2024, and you are comparing it to March 31st, 2023, then your transition date is April 1st, 2022. It's like New Year's Day for your financial statements, a fresh start to align everything with IFRS. Here in this slide, I have mentioned the transition date details, comparative year details, and reporting year details. You can go through this note. Next, scope of IFRS 1. Who needs IFRS 1? If you are adopting IFRS for the first time, this stand is for you. It helps you prepare your opening IFRS statement of financial position. But if you are already using IFRS, congratulations, you have already graduated from the standard. Talks about the applicability for the first time adapters, guidelines for opening IFRS financial statements, interim financial reports under IAS 34, exclusion of entities already reporting under IFRS. Can we further or go through the notes mentioned below? Next, objective of IFRS 1. The main objective of IFRS 1 are to make your financial statements clear and globally comparable, provide a solid foundation for IFRS reporting, ensure that the benefits of transitioning outweigh the cost. Think of it like joining a gym. The effort is worth it when you see the results. Recognition principles. During the transition, IFRS 1 asks you to recognize all assets and liabilities required by IFRS, remove anything that's not allowed, reclassify items to fit IFRS categories. It's like decluttering your closet. Keep what's essential, toss what's not, and organize everything neatly. Accounting policies for first time adapters. Consistent accounting policies, applicability of policies, retrospective application, specific exemptions. Let's talk about the retrospective application. IFRS 1 requires retrospective application, meaning you apply IFRS rule as if you have already used them. But don't panic, there are exemptions, optional exemptions, and mandatory exemptions. Optional exemptions for when full retrospective application is impractical or too costly, for example, using fair value as deemed cost, then optional exemptions is used. Mandatory exemptions. These apply to areas like haze accounting and or derecognition of financial assets where looking back isn't possible. Is mandatory exemptions. The purpose of exemptions are the exemption under IFRS 1 are designed to ease the transition process for first time adopters of IFRS. By offering these options, IFRS aims to facilitate a smoother shift from the national accounting standard to international standard. The impact of on financial reporting is the availability of both optional and mandatory exemption significantly impacts how companies prepare their financial statements. This can lead to variations in reported figures and accounting policies depending on the exemption chosen. Example of optional exemptions. Some example of optional exemptions include the exemptions from restating the business combination that occurred before the date of transition and the exemptions from recognizing certain financial instruments at fair value. Example of mandatory exemptions. Mandatory exemptions include rules that prevent retrospective application of certain estimates and the need to apply haze accounting retrospectively, ensuring consistency and reliability in financial reporting. The next one, presentation and disclosure requirement. Okay, presentation requirement. When presenting your first IFRS financial statements, here what you need: three balance sheets, opening, comparative, and current, two statements, each of income, cash flow, and equity, and don't forget reconciliation. This explains the adjustment you made from GAPs to IFRS. Transparency is the key. With visual disclosure requirements. Okay, let's talk about the example taking XYZ company. Let's bring this to life with an example. XYZ company adopts IFRS in 23-24. Their transition date is July 1st, 2022. They prepare an opening IFRS balance sheet, apply consistent policies, and disclose all adjustments. It's like preparing for the big presentation. You gather all the data, organize it, and present it in the best way possible. Here I have mentioned the transition to IFRS timeline details. And to talk about the benefits of IFRS adoption. So, why go through all the effort, global recognition, align your financial with international standards, transparency, build trust with investors and stakeholders, comparability, benchmark your performance with global peers. It's like joining a global club. Once you are in, the opportunities are endless. Closing. The call to action. To wrap up, IFRS 1 is your guide to first time adoption of IFRS. It's ensure your financial statements are clear, compliant, and ready for the global stage. If you are planning to transition, start early, stay organized, and don't hesitate to seek expert advice. Thank you for listening. Now, let's hear a question what challenges or thought you have about IFRS adoption. Then